Welcome back, investors, to Ticker Time News. I'm Adam, and we've just made it back to where we started on Tuesday. We opened Tuesday at 38.43, and we closed today at 38.49. We literally just spun our wheels to go nowhere. The volatility of 2022 is still here at the very end of 2022. Is that a sign of what 2023 is going to bring, at least in the first quarter of 23? I mean, we've got earnings season in just 3 weeks from now. I can't imagine that's going to be any better than the current situation we find ourselves. We are stuck underneath a nasty 38.50 resistance level that the market just can't break through at this moment in time. But the narrative for today is that today was a good day for the stock market, as some of the most beaten up names led the main indices to sizable gains and a pent-up rebound trade, right? Well, the broader market drew support from mega cap stocks today, which have suffered sizable losses in recent days on valuation concerns, presumably from tax loss selling activity by participants who bought into the seemingly invincible stocks last year. This is true, by the way. Entering today's session, Tesla. Let's pull it up. TSLA. What a behemoth Tesla is. Up 8.1% today. But it was down 42% for the month of December so far. Before today. Apple is another one. Look at this. Well, before I move on to Apple, just look at the chart here for Tesla. Remember when I said if it breaks this, area up here, watch out for, let me get the highlighter. If we break this up here for Tesla, watch out for breaking $100 a share. What did we get down to a low of yesterday? It was 109. The day before, today, I'm getting my days mixed up here. Yesterday, Tesla got to a low of 108. The day before, so Tuesday, the first day back, 108. 108 seems to be holding as a little support area now for Tesla. But watch out for $100 a share. It's just around the corner. And I'm not making light of this and trying to play some kind of joke here. Tesla being down so much in 1 month is incredible. I mean, wow. Is it really 42%? Yeah, it was. But as I'm bringing this chart in to go further back in time, that $100 price range isn't just, a number thrown out there. As a matter of fact, the lower end of the weekly expected move for Tesla is $111 a share. And Tesla, it has been hanging around that area. Now, today, of course, it popped at 8.1% and moved up $9, bringing it closer to 121 is where it closed. But if we go back here, okay, I want to mark this area off right here. This is about $60 a share. That is 2019. Remember, almost a year ago, in January of this year, 2022, I started talking about the 2019 theory and about how crazy it would be for stocks to fall back down to their 2019 highs. Well, history now shows us that many, if not most, have fallen back to that 2019 high. And Tesla is on its way to falling back to that level. If there are any hurdles with earnings for Q4, which are just a few weeks away for Tesla, we could be headed there. All joking aside, look at the volume shelf profile. Oh my goodness. I mean, it's like this. It comes out, it goes back in, it comes out a little bit. And then when we get to the 2019 high, that's where the volume profile really shoots out. So yes, I am watching Tesla thinking $100 a share wasn't far off when I talked about it last week and the week before. We got down to 108, pretty darn close. But now I'm thinking it could break that $100 a share range and head even lower as we get into 2023. The first half of 2023 is going to be very, very difficult. And I don't think this bear market that we find ourselves in is going to be any easier to manage in the first half. Now, we may start to see light at the end of the tunnel after we get through the rough part of Q1 of 23 and possibly most of Q2 of 23 before we start seeing the light at the end of the tunnel for the stock market. So I do think it's going to go lower. How much lower? I'm not exactly sure at this moment. We'll take it day by day. But Tesla here had a nice bounce, knew it was coming. It had gotten just completely oversold, and the volume was incredible. I mean, it had some serious volume. Now, Apple, AAPL for Apple. Now, it was up 2.8% today. But for the month, it was down 15%. 15%. And it's got a bit of a falling wedge pattern here. I'm not sure that it's going to hold. I think we may get a breakdown or a breakup any moment now with Apple. But this is a big one too, okay? The lower end of the weekly expected move is 127. It broke that yesterday. It broke that earlier. Well, actually, it landed right on that today. The low was 127. So it hit that weekly expected move and bounced on it. The upper end is at 136. No way do I see us going back to that. As a matter of fact, tomorrow could just as easily be a red day for the market. Now, with Tesla down 42% for the month of December, before today's 8.1% move, Apple down nearly 15%. The Vanguard Mega Cap Growth ETF, ticker symbol was MGK, that was up 2.5%, but it was down 11.3% for the month of December. Now, many stocks saw similar price action, which led to the broad-based rally efforts today. Advancers led decliners by a greater than 5-to-1 margin at the New York Stock Exchange, and a 4-to-1 margin at the NASDAQ. Now, all 11 of the S&P 500 sectors, as you can see here, finished in the green today. And with mega caps as leaders today, mega caps helped to push the communication services up to the number one spot, nearly 2.7%. Information technology right behind it. We could call it 2.6%. And consumer discretionary, which is XLY, up 2.6% as well. They were the top leaders. Now, on the flip side, the counter-cyclical consumer staples, XLP, and utilities, XLU, they fell to the bottom of the pack. Then we've got the semiconductor space. It's all sparks today, right? Let's go to SMH, which is the Van Erik Semiconductor ETF. But the semiconductor space was another source of support for the broader market today. The Van Erik Semiconductor ETF, ticker SMH, it was up 3.3% today. Taiwan Semi was a big standout in the group. It was up 4% today. Now, it held a 3 nanometer volume production and capacity expansion ceremony today, marking a key milestone for advanced manufacturing. That's why Taiwan Semi shot up 4% today and helped to lead the semiconductor sector higher. Now, notwithstanding today's positive price action, but the S&P 500, ticker SPX is what I'll use. Of course, it closed just 1 point below that sticky 3850 level, where it's been stuck since mid-December. Look at this on the chart. Let me open this up a little bit here. I've got a red line. I'll get my highlighter back out. This is becoming a very sticky place right here. This red line that I'm highlighting with the blue highlighter, 38.50. It has been resistance 1, 2, 3, 4, 5 sessions out of the past 1, 2, 3, 4, 5, 6, 7, 8 sessions. So only 3 sessions were we able to move above that 38.50. Now, not to close above, we only closed above 1 time out of those 8 sessions. So 38.50 is a sticky level, and we're literally a point away or a point under that. Now, the lower end of the weekly expected move is 37.80. I think it's more likely, because we're so stuck underneath this 38.50, that unless we get some sort of huge momentum tomorrow, which is highly, highly unlikely, we're liable to close between 38.50 and the lower end of the weekly expected move at 37.80. I think that's where we close to end out the year, which will put the S&P 500 literally, look at this, just today, year to date, the S&P is down 19.4%. Another 0.5% negative, going in the opposite down direction, and we close out the year in an official bear market, where we've seen ourselves many times this year. This was one spectacular year to short the market too. It's not very often that you can easily short the market for an entire year and come out making it big, making big money, making a nice profit for the year. These types of years are extremely uncommon. Now, history shows us that after years like this, where we're down nearly 20% for the year, the next year, the next 12 months, the next 2 years, the next 5 years are typically very, very profitable on the upside. But history has also shown us during this last week of December to close out the year that it is typically a green week. Can we get a green week? Well, looking at the stats here in TradingView, we're down 0.1%. So if we could hold on to 0.1% tomorrow, then at least we'd finish the week out flat, to maybe possibly a little on the green side. All right, so that's the S&P. That 38.50 is a huge sticking point, and it has been for a couple of weeks. 8 sessions, remember? 5 of them resistance. When we go to the SPY, we have the same thing right here, okay? And that sits right about 383 to 385 at the most. And we're sitting right there. We closed at 383. So we are at that sticking point, that sticky resistance point right now. Can we break above that tomorrow? I mean, it's highly unlikely, right? We are underneath our 200-day moving average. We are underneath our 50-day moving average, our 20-day moving average. We're connected to our 5-day EMA. We're connected to that moving average. So there's nothing to say we can't just sink right down to the bottom end of the weekly expected move, which sits at 375. So if 383 to 385 is a sticky resistance point, and the lower expected move is 375, then it's a pretty good bet we're going to end up tomorrow potentially within that range. Unless, of course, there is extra momentum brought into the market to get it above that sticky 385. I don't know if it's doable because volume will be light and we'll need volume and momentum to kick us above the 385 on the SPY. But that's the point that we have to break. If we break 385, then we could easily, looking at the volume shelf profile over here, it sticks out like this, but then we have this gap right here, okay? So if we do happen to break above 385 on the SPY, we've got that air gap right there in the volume shelf profile right here, that circle, then that could easily take us up to at least 392, which is right here. But we'd probably stop short of that at either the 20-day moving average or the 50-day, which is right at the upper end of the weekly expected move at 390. So that's the big thing to watch, okay? There's not a lot of data coming out tomorrow. There's actually only one piece I'll talk about in just a moment. But if we break above that sticky 385, then we could easily go to 390 to close out the year, because tomorrow is the last trading day of 2022. Then we can analyze the year, put it behind us, learn the lessons of the year, and move forward. Now, looking at the Qs are not in a very good situation. Not one bit. Let me adjust this chart just slightly. Pull it up so you can see it a bit better. We have made some pretty big moves here going down on the QQQ. All right. Let me just clean these two lines up right here. Okay. Now, for the Qs, here is its sticking point, right where we closed today, right here, 266, 265. That's the sticky point, all right? We also got it caught there, and we got it caught there. 265. So we did close 1 point above that sticky area. 165. Now, if this could continue, if we could continue on the SPY with some good, with the Qs with some good momentum, then maybe we could head up to the 270, 275 at the absolute most. And then we would be retesting up here where we broke down through that ascending trend line. So where do we finish the year? Probably somewhere right between where we are now and the lower end of the weekly expected move, which is at 260. So 260 is the lower end of the weekly expected move. 273 is on the upper end. Okay. And again, the 265, call it 266 in between there, that's the sticky point for the Qs where we'll need some big momentum to push us above that. And I don't see that big momentum on a Friday going into a holiday weekend. I just don't see it. Now let's look at the IWM. And again, well, I should say, if you do have questions, plug them in now, and we can talk about them. Okay, same exact thing is happening here. Look right through here, okay? You can see it right on the chart. There is a sticky point. It's 175 for the IWM, which is your small caps. 175 is sticky resistance. It has kept us down for several sessions. Only one session. 1, 2, 3, 4, 5, 6, 7, 8, 9 out of the past 9 sessions. We have closed above 175 one time. 1 out of 9. That is not a very good success ratio. Can we break above it tomorrow? Again, I feel like a broken record here. Only if we have the momentum to do so. Because the data that comes out tomorrow, it won't have a big impact on the market. So we've got 175 to watch for the IWM. If we can break that with some momentum, maybe we could have another green day like today. But it seems to be highly unlikely. Okay? All right, the lower end of the weekly expected move is at 170. The upper end is at 178. I say we finish the year somewhere between 170 and 175. That doesn't give us much room for a rally. Okay, let me talk about the dollar and the treasury market. What has kept stocks down the most over the past week to 2 weeks? Well, looking right here at the dollar, it hasn't been the dollar. The dollar has not been holding the stock market back. If we draw some trend lines here on the dollar, looking like that, okay? And then let's put one on the bottom. We can go back here and we can come right up like this. Now, the dollar is getting into an interesting situation. And we know all through 2022, at least up to December, the dollar has been strong. It has been in an uptrend. But a very important trend line, okay, or support line that the dollar has yet to break is the 102.5. For me, 102.5 signals the dollar is done. The strength of the dollar is done. But I don't think it's quite done yet, okay? It's been subdued, I guess I could say, for the past several sessions. So when we're looking at this chart, the dollar, it's not responsible for the market's underperformance for the past several sessions, being stuck under a key resistance level. All the main indices, it's been mega cap stocks, one, holding the markets back. The dollar, it's been moving sideways. That's not doing it. But looking at the treasury market, we'll see something a little bit different, okay? The treasury market today, it settled kind of mixed. The 2-year was up 2 basis points to 4.37, but the 10-year fell 6 basis points to 3.83%. So this is one of the real reasons the markets and the mega caps have been underperforming for the past several sessions, because the 10-year has been rising again. Today, the 10-year stopped that advance that it's been moving on for the past 2 weeks, which allowed the equities, stocks, the main indices to rise. This is the big culprit holding the stock market back. So, what will the 10-year do tomorrow? Will the 10-year continue its march higher? Or will it come back down to earth a little bit? What's it going to do? Well, let me zoom in here real quick and just show you 2 things. 2 things. Number one that I want to show you is that it is slightly disconnected from its 5-day EMA, okay? And it has been for 2 sessions now. And we all know how important the 5-day EMA is. If the candle stick, the wick and body, all included here, if they are disconnected, not touching that 5-day EMA, it's like a circuit where the switch is turned off and the electricity cannot flow through. Once it's reconnected to the 5-day EMA, then the electricity can flow through. The switch is open. So The 10-year coming down tomorrow to reconnect with that seems highly probable. That could provide a little weight taken off the shoulders of the main indices tomorrow. Just a little, though. It depends on the rate of change and how quickly and how fast and how much of a move the 10-year wants to make tomorrow. Because you can see it's been steadily marching higher. Now, just because it's disconnected from the 5-day EMA, it doesn't mean that it's going to pull back to it and stay down there. Look right here as an example. Just a few sessions ago, it had gotten disconnected right here from its 5-day EMA. What did it do? It moved sideways for 2 sessions until it reconnected to start its march higher. Now it's disconnected for 2 sessions, so it doesn't mean it's got to go down to reconnect with it, because the wick of the candle can go down and touch it, and then buyers can step in. Well, I shouldn't say buyers, because this is reverse. This is the 10-year yield we're talking about. It's not a stock. So the yield could rise, causing the wick to reconnect, but the body of the candle to not. And that's fine. That counts as the circuit being made whole, and the electricity can go flowing through. Now, that would, tomorrow for the stock market, that wouldn't be a good thing. Maybe we could get a little bump in the morning and then sell off as the day goes on. It all depends on how the 10-year is going to move. Now, one thing I want to talk about is one piece of data that came out today, and it was the initial jobless claims for the week ending December 24th. It increased by 9,000 to 225,000. The expectation was 220,000, so about a 5,000 difference there. While continuing jobless claims for the week ending December 17th increased by 41,000 to 1.71 million. The key takeaway is that the level of continuing jobless claims is the highest since February, and up noticeably since September, when it was just shy of 1.35 million, suggesting that a very tight labor market is showing some signs of loosening up based on the extended time it's taking for dislocated employees to find a new position. That's important, because remember what the Fed's been talking about this whole time. They need to see unemployment go up. They need to see unemployment go up, inflation go down. That is a key part of the equation. So if the Fed does get that combination, inflation coming down, jobless claims going up, that would be good for the Fed and their slowing of the rate hikes. All right, let's throw this up. Might as well. Do you think jobless claims will tick up after the holidays? I do. I think jobless claims will tick up throughout the first half of 2023. How quickly, I'm not quite sure on how quickly that will occur. But as the economy is slowing down, it is a given that unemployment will go up. Now, unemployment has been stubbornly strong over the past several months, actually this entire year. At the beginning of the year, would have thought unemployment would have been higher at this stage of the game than it is currently. It is not. So, again, I'm not sure how quickly unemployment will go up, but it will go up in the first half of 2023. I'm firmly behind that one. I think there's no chance, especially as we go through earnings, our very first earnings season of 2023, which kicks off with the banks in a few weeks. I don't think earnings are going to be very positive. I think they're going to be very dark, gloomy, maybe even downright shocking. Because there hasn't been a whole lot of revisions down. Plus, I think one of the most important things in 2023 is going to be valuation. Valuations are still too high. Valuations are still too high when you compare it to the earnings that will be presented in 2023. Q4 earnings come out, I believe it starts in the third week of January of 23. Just look at Tesla for one quick example. TSLA. Valuations will matter, and I think it's going to be one of the very key data sets that we will be able to look at in 2023 to determine where the market's going and where should we be investing or trading. And just looking at Tesla here, its valuation has been coming down hard. Remember, I talked a lot in January and February of this year about the 2019 theory. Now that we're at the end of the year, many companies have reached that 2019, their 2019 high. Tesla hasn't gotten there yet. I mean, that's around $60 a share. That seems like a long ways down from where it's at right now of $121 a share. But when it was at $108 a share, it didn't seem like it was too far off. So valuations are going to matter big time in 2023 because will earnings match where the valuation of the company is? And it'll be a real quick equation to be able to solve and figure out whether the company's valuation matches with its earnings. And unfortunately, this is why big tech has been getting hit hard. Yes, the 10-year yield going up has played a role. But their valuations are still too high. And that's affecting them here in the last week of the year. And it's going to affect them a lot in the first half of 23. Okay. When does the market start seeing an increase in jobless claims as bad? I thought it would be by now since things are slowing down. I thought they would be by now too, but coupled with that, I thought unemployment would be higher at this point right now. It's not. See, the problem with jobless claims for the year of 2022 is they remained steady. The job market remained healthy. Sure, there were hiring freezes. A few hundred were let go here at that company, a few hundred at that company, maybe a couple thousand over there. Meta, but it wasn't severe. there were not severe job cuts at a lot of companies. Unfortunately, though, with the jobs data today, and the reason the market took it as good news, even though those jobless claims were going up, has to do with the Fed. Remember, the Fed has two mandates. Number one, full employment. Number two is to bring down inflation. Well, inflation came down for our last CPI reading. That was a good thing. Unemployment right now with jobless claims went up. People were laid off. In market participants' minds here, that is a good thing for the market. Why? Because the Fed will slow its rate hikes. And if unemployment is going up, because the Fed needs unemployment to go up and inflation to remain on a track of going down, that means the Fed is closer to pausing its rate hikes and not going any higher. And I think that could come in their February 1st announcement. February 1st, 2023. That could be a 25 or 50 basis point rate hike, depending on what the data says between now and then. And that could very well be the last rate hike for the Fed in this cycle. And then the Fed will hold at that rate hike, at that rate, at that Fed funds rate, which will be right around 5.25%, depending on where they go with a 25 or 50 basis point rate hike on February the 1st. So, jobless claim data that is going up, market participants like that news. Just to kind of recap here, the reason market participants like to see jobless claims go up, that means the Fed is closer to pausing its rate hikes. Now, if the Fed has already paused their rate hikes, let's jump ahead a few months. Maybe we're in April or May of 23. And the Fed has already paused its rate hikes and it's holding steady. Jobless claims, if they start going up too high, then that will be seen as bad news. The higher jobless claims go, the weaker the economy is. The weaker the economy gets, the harder it is to open it up and get the economy pumping again, working again, and going back up. Okay? So it's like, for example, if you dig yourself a 3-foot hole, sure, the average person could very easily get themselves out of a 3-foot hole. If it was a 6-foot hole, it would be a little harder to get out of that hole. So if the economy slows down to that hypothetical 3-foot hole, it's a lot easier for the economy to get started again and get out of that hole and start growing. However, if the economy gets in that 6-foot hole, it's a little harder to get out of, meaning it's going to take longer for the economy to get going again and to start growing again. Those are a few of the reasons for why. Keep them coming. Keep your questions coming. I know I've missed several days. You can probably still hear it in my voice here. Getting over a nasty cold. I can't believe that's what I got for my Christmas present. I can't start laughing or I'll start coughing this year. All right. Well, that did wrap up my notes. I've already talked about everything I wanted to. So get your questions in if you have any. Now is the perfect time. I didn't want to go too long. Obviously, I don't know how my voice sounds coming through on the other end, getting over this cold. But I did want to quickly mention about tomorrow, because we do have at least one more data point to look forward to for tomorrow. And that's the December Chicago PMI. And the expectation is a reading of 40. The prior reading was a 37.2. So just a tiny little bit of expansion there. A tiny little bit. And that report comes out at 9:45 a.m. Eastern. So that's the only real significant data that comes out tomorrow. Again, that's the December Chicago PMI. The expectation is 40. The prior reading was 37.2, and it comes out at 9:45 a.m. And that's it. And tomorrow will be the last trading day of the year. It is a Friday. It's a holiday, going into a holiday, so it'll be lower volume type of day. Kind of how last Friday was. Let me just go back here right quick. Whew. It jumped. It jumped on me. Okay. I see those questions. I'm going to get right there to them. Just wanted to open up this SPX chart for the S&P. Just want to go back and look. Last Friday, I'm just looking at last Friday's volume. So it was 1.5 billion trades taking place on the S&P 500, ticker SPX, where the average is 2.4 billion. So nearly a billion trades less last Friday going into the holiday weekend. So I'd expect the same thing. I mean, if we look at this last Friday, 1.5 billion. This Tuesday, 1.7 billion. Wednesday, 1.7 billion. And then today, 1.7 billion. So that's probably where we'll end up for tomorrow, somewhere around that. Okay. What do you do when markets are closed? I feel so useless when markets are closed. Well, when markets are closed, it depends on what the family wants to do. But spending time with family. That's what I'm doing when markets are closed. I will spend time either in the morning or in the evening looking through charts, researching, studying related to the market. You can do back testing on charts. If there's a strategy you wanted to try, you could do that. So I typically spend it family. And then secondly, again, maybe a couple of hours. It really depends on what the family wants to do. It could be more, it could be less. But then I'm spending it on charts and research for the most part, or even reading as a possibility. So that's what I'm pretty much doing when the market is closed. Mainly family. Okay, let's see. Where was that last one at? All right. So, do you think China's death rates for COVID will affect the supply-demand situation? And if so, how can this contribute to rate hikes, etc.? Thinking Fed is not slowing. Okay. So, China's death rate, who knows what it really is, right? I don't think the Chinese government is going to be at all honest about what the number is. Now, there's one, I'd have to get my tinfoil hat on. I can't remember which news source suggested it or where I even heard it from or where I even saw it. It may have been something I saw on Twitter. It may have even come from Elon Musk, one of his outrageous tweets. But anyways, it was since China was opening up to allow Chinese citizens to exit the country and go to other countries, what kind of strains of COVID is the Chinese government spreading at that point? I have no idea. It's a interesting thought experiment. But I don't think it's what has the actual impact is whether China opens or China closes down. That's what has the biggest impact. Think about the iPhone, for example. If a manufacturer of the iPhone in China, if that community is shut down by the government, by the CCP, then those iPhones aren't being made. So then Apple can't meet demand. And then Apple has a problem with too little supply. If the Chinese government does not close down and opens up, then those factory workers are on the job building the iPhones, and the iPhones are getting shipped out, which in that case, Apple can meet the demand. And either way, whether the Chinese government shuts down or opens up, it has a direct effect on earnings. A direct effect on earnings. So that's the biggest, I guess, thing to watch. The death rates, I don't think play much of a role because I don't think much of the world believes what China says. But whether China is open, allowing manufacturing to take place, exports to be shipped out, I think that's the bigger thing to watch versus the Chinese government shutting down, okay? The Chinese government opening up will also allow oil prices to go up because when China is open, manufacturing is taking place, burning coal, etc., other fossil fuels, petroleum, etc., you name it. Ships are going out, trucks are driving down the road. So an open China is a better thing for our own economy than a closed down China. So for me, That's what I pay attention to when it comes to China. Now, a lot of Chinese stocks have been very volatile. They've shot up tens of percent. They've gone down just as much, if not more. All based on the narrative of, oh, China's opening back up. Oh, China's closing down. Oh, it's opening, closing, opening, closing. I mean, just think over the past 6 months, how many times have I talked about, oh, in the headlines today, China was opening up their economy. Oh, in the headlines today, China was shutting down their economy. That's the biggest thing to pay attention to because it has the direct link to a company's earnings if they have manufacturing from China. Think of Tesla too, with their Shanghai facility. So that's what I would watch. How it affects supply demand? Well, I think I answered that one. With the factories being closed, then there's no manufacturing going on. That's going to hurt the supply. Again, using iPhone as an example. If China is open and the factory is open, then they're producing the iPhone, and that is helping to close the supply-demand gap. I don't think China being opened or closed would contribute to rate hikes in our economy or what our Fed or our central bank is doing, but it most certainly would affect China's central bank and its own rates. But I don't think an open or closed China is contributing to rate hikes or lack thereof with our central bank, our Federal Reserve. I guess the only way you could potentially make the case for some sort of a connection between China's central bank and our own central bank is if the dollar is strong or weak compared to their currency, which is heavily manipulated. But even then, I don't really think there's a direct effect to rate hikes that we would feel with China being open or closed. I guess maybe the only other one outside of the currency itself could be if China was holding on to the one COVID policy or whatever they called it, is if they were locking down and shutting down, and by doing so, demand skyrocketed for certain products, which caused inflation in our country to start creeping back up instead of moving lower, like the Fed wants to see. So, number one, just watching whether China is opening or closing. That's the big thing. And then number two, if they are closing, what does the demand-supply balance look like? Because if that supply imbalance is low and the demand is high, that could cause prices to go back up, causing inflation to creep back up. So those are the two things that I would pay attention to the most for China. I watch YouTube videos and study how to use different indicators to help my entry and exits. Yeah, it's YouTube's a great resource. One thing that I like, and I haven't incorporated it with the live stream, and it's something that I do. It's kind of costly, but if you are trading a lot, it can be extremely beneficial. And just to, I'm going to take some of these lines away here on the chart. Now, on the chart, the purple lines going across the screen, those are the weekly expected moves. That's important for me when I'm trading. The two black lines are the anchored VWAP for the highest closing price of the year and the lowest price of the year. And that gives us this gap between the two. We've been steadily staying underneath here for the past week and a half. Level 2 data, okay? On most of your brokerage apps that you're using, I'm making a switch right now from TradeStation to Thinkorswim TD Ameritrade. I'm making that switch right now. Now, the one thing that I like about the level 2 is being able to see where orders are. Because if you know where demand is, you know where to watch for an entry or exit point. The problem is when you're looking at that level 2 data, it just looks like 2 columns of numbers, and it's way too difficult to try to figure out what that means. So one thing that I use, and let me pull it up and show you right quick. It is a little costly, but if you're doing enough trading, then it is, I believe, worth it. But it's bookmap data. So let me bring this over here. I haven't shared this before. But basically what it's doing, if you notice on the screen here, it's taking your typical candlestick chart and it's giving you this heat map over it, but it's doing way more than that. Way more than that. It's showing you where orders are hiding out. And that's the biggest thing. The graph here on the right-hand side, this says the title for it, current order book. All right, right here. The red and green. When you see look at the red part of this image right here. And there's this spike that's sticking out on the red part. And the spike is sticking out to the right side, okay? And then to the left side of where it's sticking out, there would be a number. And that spike means that there's a whole bunch of orders waiting at that price point. Bookmap allows you to visualize that level 2 data. And the biggest thing for me is that it uncovers, it allows you to kind of see through who the wizard is, where those orders are sitting and waiting to be filled. And that lets you know where your entry and exit points, where good places are to look. Like this image right here to the left-hand side, the redder the area, the more orders there are at that price point ready to be filled. Or in this case of this image, have already been filled, because this is showing you with the candlesticks. But this is one of the, I'd call it a secret weapon for trading. But it is a little bit on the expensive side. But I love it. And if you're doing a lot of trading, this is, oh my gosh, so incredibly, like it says here, stop trading in the dark, turn on your headlights. It literally is doing that for you. I mean, it is just, to me, it is a secret weapon. It really, really is. I should probably try to get a sponsorship from them, huh? or something. Who knows? But just sharing that to me is one thing that I absolutely love, because when you're looking at candlesticks, right? You know, this is the daily, but pretend it's the 5-minute chart. You don't know where the orders are. You just see the candles moving. And with the level 2 data, maybe you have it over here on the side, and you see the orders coming through, the bids, the asks, and they're just flowing. But you can't visualize and make sense of these 2 columns with orders and numbers attached to them. It's just a stream of numbers, and humans aren't programmed to be able to visualize that. But Bookmap allows you to visualize where those orders are. And you know, for example, for the S&P 500, there have been a lot of orders, you know, hanging down here, like around the 3,700, 3,705 area. And with those orders just hanging out there, you know that when the market gets down to that level, there's going to be a bounce, because those orders are there. And with that heat map, it's showing you, literally removing the veil so you can see. Sorry to ramble on about it, but it's just one of the tools outside of just technical analysis that you can use that is so helpful. Going back to what do we do when when the market's closed? Yeah. I have level 2 on Webull. Yeah. I haven't been in my Webull account in a while. I don't even remember what their level 2 looks like. And I have no idea if they've even updated to try to add any type of heat map or a way to visualize where those orders are. Oh yeah, cool. I'm thinking that what I'm going to do, Webull is terrible. Yeah. I used Webull for just the free stocks, and didn't really do anything on the platform. I think I've got a few shares of the, I think the ticker SPHD. It's one of those low volatility, high yield ETFs. Yeah, there's better options out there. Webull and Robinhood, they just catch those especially Robinhood. They just make trading stupidly simple. Like, you can't mess it up. I think it's okay for holding. If you're investing long term to buy and hold, that's great. But trading, you need a little more sophistication with what you're doing. So I think in 2023, I think what I'm going to start doing is I'm going to incorporate some of the bookmap charts to help us all identify where orders are hiding out. It's not static, it's fluid. So it is constantly moving. But I think it would help identify key areas, at least to pay attention to. And I think that would help to provide some value during these live streams, for sure. Let's see here. Yeah. Okay. Primarily trade options. Yeah, I do a whole bunch. I'll use options. I'll buy the inverse ETFs, the leveraged ETFs. I'll use a couple different trading strategies at a time when I'm trading. And I don't trade every day. I don't force a setup. If the setup is there, then I'm on it. But if there's no setup, I'm not just going to throw money into some place hoping that the market moves in my direction overnight and I catch those gains. Like this morning, right? Today's moves up, it was all this morning, and then that was it. It was a narrow trading range and stayed flat for the majority of the day. So being able to catch those swings, sometimes I don't, because I'm not holding overnight unless the trend is in that direction. So yeah. Okay, anything else you guys want to talk about or want to ask about? Or we can wrap this up till tomorrow. Tomorrow we'll look at how things did on a yearly basis and try to recap I mean, my goodness, look at this. I mean, almost all the gains of 2021 were given up this year. That's incredible. That's incredible. 2021 was almost practically erased. You are welcome. Absolutely. I'll see you tomorrow. Just so everyone knows, I'll be back tomorrow after the market is closed to talk about what happened, why it happened, and what to expect going forward. And we'll kind of do a little review here about how things did for the year of 2022. And then we'll pick up on Tuesday, the 3rd, which is the first trading day of 2023. I can't believe we've got one trading day left. I can't believe it. We typically start, but see, I want to give a poll. This is great, Rebecca. Perfect. Absolutely perfect. We typically start somewhere between 7:30 and 8. But I want to send out a poll to you guys, and I don't know how to do it in the live chat. I meant to figure that out over the holiday break. To see what time works for the majority, right? So we start at 7:30 and we call it, all right, 7:30 Eastern. That's when we start every single day. Or is it 8 o'clock Eastern? So that way we have a set time. I think that is important. It definitely helps with structure and knowing when we start. So let me know in the comments, what do you think the best time is? 7:30, 7:15, 7:45, 8 o'clock, and these that's all Eastern times to get things rolling, because we typically go for about an hour, talking about the market, charts, answering your questions. Yeah, we've really been going right there between that. 7:30 and 8. I try to give 7:30 the best shot. 7:30 to 8 gives me a little wiggle room if you're running late. Okay. Yeah, it seems like that's where I need to pick. 7:30 to 8 p.m. Eastern. I need to pick a set time in there and then roll with it. Maybe something right down the middle, 7:45 Eastern. And that be the set time. Even though that seems like an odd time to start. Every show you watch on TV. Well, we got just say between 7:30 and 8. Yeah, I could do that. But I think having a set time, it would be appropriate. I think so. 7:30 to 8 every night. Earlier on Friday. Can you do the annual review Sunday idea? On Sundays, I used to do a breakdown of what's coming up this week. What did I call it? Catalyst Watch. I think I called it Catalyst Watch, and it was for the upcoming week, and I did it Sunday evenings. But it kept running into our family time on Sundays, and just need to find a way to work around that. Because quite frankly, it was the most popular videos I did all week. That Catalyst Watch video on Sunday evenings. I did it live. I didn't take questions during that live stream, but I did talk about the upcoming week, what to watch out for each day, and so forth. And it was one of the most watched episodes that I would put out throughout the week. So in 2023, I'll try to get that rolling again, because that seemed to work out. Catalyst Watch, Sunday evenings. Okay. Oh no, family first. Yeah. Sunday is a good one. Record it Saturday, premiere it on Sunday. That's actually an excellent way to get around it. A Sunday market prep video would be great. Yeah, it was. It was a good video. Catalyst watch. Stock set to move. I think that was the name that I did, and it was the same thing in the title. And we talk about what earnings are coming up, what are the biggest earnings to pay attention to, what economic events were coming up for the week, what type of news could be dropping in the week ahead. It was just stuff to prepare you for the upcoming week. Things that I'm already got written down in my notebook that I'm like, yep, this is what I'm doing for this week ahead. This is what I'm watching for this week ahead. And it was a good one. It really was. Yeah, I like Sunday, but of course, family first. Yeah, family always first. You'll have the good life. Family first, good life. That's what I think. But yeah, I'll talk to my wife and I'll see if I can't get a Sunday video out. Recording it on Saturday and then doing a premiere on Sunday, that seems like a fabulous idea and a perfect way to work around family time. So I'll see if I can't get that scheduled down, and then we'll go 7:30 to 8 is the start time for our daily videos, our daily live streams, and then I've got a whole list of things that I want to do differently to provide more value during these live streams for 2023. So I hope it works. It's one of the reasons why I'm switching to Thinkorswim's platform instead of TradeStations, because I think there's a couple things that I can use in there to help make the live streams a little bit better. Okay. All right. Okay. So I'll try to figure out what works best. How can I get to 7:30 and 8 and pick a number that I can keep, because I don't want to set that number and then be late and disappoint you. So I'll work that out over the next few days, and then we'll kick it off 2023 with a bang. Awesome. Yeah. Thinkorswim, I like the platform. I've used the free tools before, but I've never used them as my broker. TradeStation, it linked up and synced with TradingView, and I love TradingView. There's so many things you can do with TradingView and charting. So that's what I had run with for a while. But there's a few benefits that are over on Thinkorswim that TradeStation doesn't have. And that's why I made the switch. So it's in the process of moving over right now. All right. Well, we'll wrap it up here for tonight. Thank you for being here with me. I greatly appreciate it. And we'll be back tomorrow. And every day the market is open. Right now, the time is 7:30 to 8 p.m. is when we'll start Eastern time. I'll pick a number and we'll stick to that number. Tomorrow is the last trading day of 2022, so we'll kind of do a little review tomorrow. I'll make it quick. I saw your idea about going a little earlier on Friday. I know Fridays are kind of like an odd one. It's usually the least watched video of the week, and I understand that. You know, y'all are doing your thing, and that's wonderful. Don't need to stick around and continue to talk about the market when you're starting your weekend. So I completely get it. And I'm gonna put some serious thought to restarting the Sunday evening program, Catalyst Watch, Stock Set to Move, talking about the week ahead and what's coming up. I don't care about Fridays. Yep. Happy New Year to you guys too. If I don't see you tomorrow, I'll see you fresh in 2023. Have a wonderful evening, and yeah. Again, this is the worst part of the live stream. Trying to say goodbye. I'm never good at saying goodbyes. Hardly can ever figure it out. So with that said, I will see you guys tomorrow. If not, I'll catch you fresh in 2023. Thank you for spending your time here. I greatly appreciate you, your questions, and your conversation. It's awesome. And click that like button, share the video with a friend, and hopefully I'll be fresh over this cold and by the time we get to 2023, and we'll kick it off and have a wonderful year and a successful year. So thank you guys so very much. I'll see you in the next video.